Thanks, Peter, and happy to be here today to discuss Healthier with the Switzer investors. I'll start by giving a brief overview on Healthier and who we are, and then I'll move into our most recent acquisition, which was the acquisition of the Optical Co, and then give you a bit of a flavour on the FY21 outlook for Healthier. So essentially, Healthier's vision is to grow Australia's largest diversified healthcare provider. We're doing that through allied health services at the moment. So the business consists of two very distinct consumer segments, being our Bodies and Minds and our Feet and Ankle divisions. Inside Bodies and Minds, we have our physiotherapy clinics, our hand therapy clinics, occupational therapy, and some other allied health services, so Pilates, some speech therapy in there, and the like. Our Feet and Ankles division is our podiatry services. We have retail footwear stores where we have retail footwear at the front and podiatry services at the back. We own our own orthotics manufacturing lab, which manufactures the inner soles for our podiatry customers, and we own our wholesale distribution business, DBS. So Healthier were listed on the Australian Stock Exchange in September of 2008. So we're just over 2 years listed. We listed with 104 businesses, and we've grown to over nearly 200 businesses since that point in time. We've developed a very focused growth model for the business. It's focused on these five pillars of growth here on this slide. Part of our strategy is to be clinician-led. So inside of our Bodies and Minds and our Feet and Ankle division, we have our founding clinicians that still lead and run the business for us. So we have two founding physiotherapists, Tony Ganter and Lisa Roach, and inside of our Feet and Ankle, we have four founding podiatrists, Dean Hartley, Darren Stewart, Glenn Evangelista, and Greg Dower. So we've got a clinician-led focus model, which we think is important because they really understand deeply how the patients feel and the staff feel on the ground. Those clinicians are then supported by senior management who have experience in corporates across Australia. So my background, I'm an accountant. I worked for 7 years as the CFO at Green Cross Limited with Glenn Richards. We grew a portfolio of vet practices from 30 to 200, merged with Pet Barn before I started to work here in Healthier in this business. We have some very targeted organic growth strategies with patient focus. So it's really about the patient outcome and the patient experience in our business. We have a clinic retention program. So what that program is we allow our clinicians to continue to own a portion of their practice. So they can own up to 48% of their practice alongside of us. They provide the ongoing day-to-day management of the clinic, and we provide the back-end support to support them so they don't have the small business hassles of having to pay super and recruiting new people, BASs and the like. We have really structured education programs, and it's one of our key selling points for our staff. They're world-class programs that's headed up by Dr. Kerry Evans, put frameworks in place to really ensure the standards of care and the patient-focused outcomes that we're after really occur across the business. Those education programs are then supported by a clinical advisory committee. So that committee exists of experienced clinicians who set the standards of care across the group. And then obviously everything is centralised at the back end, and we support the businesses, and we have internal controls in place for the businesses from that back end function. Another part of our organic growth strategy is to co-locate or introduce new services into the existing businesses that we have. So we can acquire a physiotherapy clinic, and we can utilise our podiatry workforce to put a podiatrist inside of that existing physiotherapy clinic and introduce those additional services and get those cross referrals into that business. Or we can acquire a podiatry business and they may not be doing laser fungal surgery, so we can introduce that service into that new clinic. The third pillar is the rolling out of new multidiscipline allied health clinics or retail footwear stores with podiatrists in the back. So we've had success in doing that, albeit we've only done a couple over the period of time, but there's the ability for us to open up a new multidiscipline allied health clinic that's anchored by a physio, but then we have podiatry services in there, hand therapy services and the other services we across the group, or have retail footwear store at the front and podiatry at the back. The next one is our vertically integrated strategy. We obviously own iOrthotics, which is our orthotic manufacturing lab. It produces the orthotics that are sold through our podiatry clinics. We also own an allied health supply business, DBS. So that just helps drive and improve margins across the group over time. And our fifth one is our acquisition strategy. So we'll continue with a targeted acquisition strategy, looking to acquire well-established, well-run allied health businesses, and we'll bring those into the portfolio as we go forward. So highly fragmented industries that we're working in, with a lot of acquisition opportunity, with multiples ranging between 3 to 4.5 times EBITDA. How does that look as, what's our addressable market? So Healthia is targeting about $2.7 billion in our feet and ankles division. So that's podiatry, orthotic manufacturing and retail shoes. And then in our bodies and minds division, about $3.8 billion of addressable income inside of Australia. So physiotherapy, hand therapy, OT, speech and the like. So total addressable market of $6.5 billion. Healthia has less than 2% of that market at the moment. Key highlights of FY20, underlying revenue was up 40% to $92.5 million, underlying EBITDA of 13.2, up 47% on the prior year, and our underlying net profit after tax of 4.6 million, so up 37% on prior year. We paid our first dividend. We paid a 2-cent dividend at the end of FY20. It was supported by a DRP and was fully underwritten, so we could manage our need for cash to continue to grow through acquisitions. We deployed $18.2 million worth of capital on new acquisitions at an average EBITDA multiple of 4.3, and we converted cash at around 136.8%. So the businesses convert cash quite well. We grew the portfolio by an extra 31 clinics to 152 and grew our clinician numbers to 568, with that clinician retention rate sitting at about 85%. So that was up on the prior year as well. So what's happened since year end? So we've just settled on the 30th of November, the Optical Company. So the Optical Company is an optometry business that was established in 2008 by a registered optometrist, Colin. Colin grew that portfolio to 41 optical stores across Australia, predominantly Queensland, New South Wales and Victoria, with 2 in South Australia. They're optometry-led. So as I mentioned earlier, a key one of our strategies is to be clinician-led. This is a clinician-led business with a focus on patients, with a vertically integrated model and the ability to continue to grow over time through acquisitions. So it ticks off all of those key strategic components of what we're doing. The optical business has had great growth over the last 10 years. You can see there demonstrated by the graph. They've grown from 26 million in FY17 to 35.8 million in FY20. So why optometry for Healthia, given that we're currently in podiatry, physiotherapy, OT, that kind of space? There's attractive growth drivers in the optometry industry. So the optometry industry is expected to grow at 2.1% per annum through 20 to 25. There's a demand for eye care services due to the ageing population, plus the awareness of eye health and UV eye protection that's coming through. The industry is still quite fragmented. There's large players of Specsavers and OPSM in the industry, but of the $3.8 billion of industry revenue in Australia, 2.2 of that is still held by independent operators. So, that's 2.2 of the 3.8, which is still highly fragmented, with 2,007 independent operators holding that. And with all of that, the Optical Co is very aligned to our 5 strategies. Clinician-led, supported by a great management team that's got experience in optometry. They've got the vertically integrated strategy. They've got the organic growth strategies that very much align to ours, and there's still ability to continue to grow due to the fragmented nature of the industry. So how's Healthia look then as after the 30th of November? We now run 3 distinct consumer segments. So we've got the bodies and minds, the feet and ankle, which we closed FY20 with, and we've now added the new division of eyes and ears. So the Optical Co brings in the brands of the Optical Co, Kevin Paisley, Stacey and Stacey, NIB Eye Care, and the Optical Warehouse. There's a plan and a feasibility study is being done to co-locate audiology services inside the optometry businesses, similar to what we do with our co-locating podiatry services inside our physio business. And the optical business also runs a business called AED, so Australia Eyewear Distributors. So they're vertically integrated, as I mentioned. They have their own white label frames as well as source international brands which they distribute to their stores. So Healthia would have looked like this if we were a combined group for all of FY20. So as I mentioned earlier, in FY20, Healthia delivered $92 million worth of underlying revenue, underlying EBITDA of $13.2 million, and underlying profit after tax of 4.6. So EPS of 7.3 for the year. If we were to hold the Optical Co for the whole of FY20, we would have delivered $128 million worth of revenue, so up 40% on what we reported, 18.9 million of underlying EBITDA, so up 43%, and underlying profit after tax of 7.4 million. As part of the transaction, we've just completed an entitlements rights to existing shareholders of 15 million, plus the vendor of the Optical Co is taking 9.4 million in shares. So 25.4 million of new shares were issued as part of the transaction, which moved EPS growth from up 15%, from 7.3% to 8.4%. The other key component is we maintain our ability and capacity in our balance sheet to continue to grow post the acquisition. So we have a $50 million debt facility with the ANZ and BOQ. That facility will be drawn just over $40 million. So we've still got capacity to continue to grow in the current facility. Plus we have excess cash that we're sitting on at the moment to continue to grow through acquisitions. If the optical business was there in FY20, how would have that looked from a segment perspective? So our 3 distinctive consumer segments of feet and ankle, bodies and minds, and eyes and ears, it would have been quite an even spread between each of the divisions. So each of them contributing nearly a third to the overall performance of the business. So the Optical Co comes in about the same size as our bodies and minds and our feet and ankles division. And so that maps quite similar to the addressable market that we now have. So I mentioned before our addressable market was $6.5 billion with feet and ankles, bodies and minds. We've added the eyes and ears division, which is audiology and optometry, of 3.3, which has taken our addressable market to 9.8 billion. So we're still holding less than 1.5% of our addressable market. That just shows the run rate for growth that we have into the future. So what does the future look like for Healthia? We recently reported that our organic growth through the first quarter, so July through to September, we had 10.9% growth through each of the 3 consumer segments. So the feet and ankle businesses delivered 13% organic growth. the bodies and mind 14%, and the eyes and ears 4.7%. So that includes any impacts from the lockdowns in Victoria during that period due to COVID. So it shows the repeatable, resilient nature of the income of these allied health businesses that we are operating within. Moving forward, we'll continue to look to deploy capital to acquire new businesses. As I mentioned earlier, we've already deployed capital for the acquisition of the Optical Co. But on top of that, we've also deployed another $10 million year to date on the acquisition of physiotherapy and podiatry businesses. So that brings me to the end of my presentation. In summary, Healthia runs three distinct consumer allied health divisions. We were looking to deploy $20 million of capital to continue to grow those divisions over the next few years. And we are extremely proud of the organic growth that we're starting to achieve in the business. Thank you.